Good morning and welcome to Core Wealth's monthly wrap-up for the month of June 2019. As always, there's been a lot of noise in the market since we last spoke, and that continues. Donald Trump still has his Twitter account. There's still a lot in the headlines. We had the G20 summit, but the world is moving forward. We've seen the US economy continues to perform well, which has a knock-on effect onto the rest of the world. Global growth is slowing, but we don't believe that we're heading towards a recession, and the policymakers and the reserve banks around the world are acting in order to make sure that that slowdown is not too severe. Probably the biggest news there has been that the US Federal Reserve, their Reserve Bank, has indicated that it expects to cut interest rates into the future, and this in an attempt just to make sure the US economy doesn't slow down too much. The one effect of cutting interest rates, though, is that in the US's case will weaken their currency, and we've already seen that coming through. The rand now against the US dollar has been below 14 at the time of recording, and this is because of the expectation of lower interest rates in the US. Our expectation for global growth is that it will slow, but we don't see it reaching recession levels. In South Africa, we've seen some good rain since we last spoke, and especially in the Western Cape, and that will help reduce the risk of drought conditions into the future. The dam levels are at much better levels than they have been in the last 3 years. We've seen some actions from government following the State of the Nation address, and we do think that the tailwinds are starting to build in terms of South Africa's economy, and we're seeing some good policies being put into place and some good actions from government. These are all positives into the future for South Africa. We're not out of the woods, and it's not going to change overnight, but the tailwinds are starting to build up, and we expect to see the results of that over the coming 2 to 3 years. Moving on to markets over the last month, we've seen a good June in that equity markets in South Africa were up strongly, over 4% for the month. Global markets were also up nicely. And so if we look over the first half of this year, the local equity market is up over 12%, and global equity markets, particularly in the developed space, are up over 14% year to date in rands. Those returns over the last 6 months are a welcome turnaround compared to what we saw in the last quarter of 2018. And this reaffirms our view that investors need to stick to their long-term strategies. The risk at the end of December last year was having seen the poor returns, particularly in that last quarter, of becoming more conservative and moving into cash, for example. Had that happened, investors would have missed out on a strong and healthy turnaround in the local market, as well as the global market, and missed out on those returns for good. We'll move on now and talk about what our expectations are for the future. There's been a lot of commentary and research coming out of Investec recently, where one of their portfolio managers who runs their balanced portfolios has been commenting on the type of returns he sees going forward. And he's talking about returns of around 15% over the next couple of years. Just an indicator that valuations at the moment are really good or cheap, and the prospects for these kind of companies going forward are healthy. The second bit of research is from a company called Obsidian. They're an asset manager up in Johannesburg, very experienced, has been around for a long time, experienced team, and they just did some relatively simple analysis looking back over the last 30 odd years at periods when we'd seen negative returns in balanced funds in a calendar year. Now that's only happened 4 times over the last 30 years, and it's interesting to have a look at the returns after those calendar years where you had a negative return. Now, if I have a look at the 3 previous periods where we had a negative calendar year return on average on balanced funds, the average return for the following 3 years was well ahead of 15%. In fact, in some cases it was in excess of 20%. Now, the last time we had a negative return in South Africa on average on balance funds was actually last year. The third bit of research was some research that Alan Gray did, having a look at periods going all the way back to the beginning of the last century, beginning of the 1900s, and looking at periods where cash outperformed shares or growth assets, and then having a look at the subsequent return that you achieved on shares after a period where you'd had cash outperforming the equity market for a period of 5 years. And based on this research, their current statistical estimates looking forward is that there's an 87% chance that shares will outperform cash over the next 4 years. Those are substantial odds, and again tie back to some of the things we've spoken about now and in previous video recordings. The last bit of research is just some that we did here at Core Wealth, again looking at the prospects of future returns after you've had a period of equities underperforming cash, which is what we've seen over the last 5 years. And the research that our team did was just to look at how big the upside is, or the outperformance is, after you've had a period where cash has outperformed equity. And the last 5 years have been a strong period for cash relative to equity. And if we look back historically on this data, and this data we've gone back nearly 50 years, the following period we're expecting to see returns of as much as 11% ahead of cash. If cash is about 16%, that could mean returns on equities of around 17%. Now, any one of these single bits of research could be just assumed to be interesting at best. But when you add them all up and you realize that all from different sources, these are pointing to the coming years could be very attractive for investors. This is not the time to be shrinking back and putting all your investments into cash. Now, none of our portfolios are exposed to one single asset class. All of our portfolios have a mixture of cash, equities, property, bonds, both locally and internationally, so they're diversified. But it's not the time to put all your eggs, especially in the cash basket at the moment. There's a saying that goes, it's always darkest before the dawn. And the recent market conditions, especially over the last 3 years, have made it quite difficult for investors and asset managers to stomach what was going on and to find sense in what was happening. We've seen this in how we've engaged with clients, and we've seen a number of our clients feeling nervous about the situation. Our advice continues to be that we have to stick to our long-term strategies. The first 6 months of this year have proven the benefit of sticking to long-term strategies and not shrinking back at a time when things seem very bad. The valuations looking forward are positive. We're not saying it's going to be a smooth ride, but with good advice and patience, we'll see the results in the longer term. I hope this video has been helpful. As always, give us a call if you've got any questions. We'd love to give you some feedback on that. Thank you.